Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Conor Ryder, head of research at Ethena, to discuss stablecoins and why we're seeing a rise of them offshore. Conor, it's great to have you with us. Welcome to Trade Talks.
Hey, Jill. Thanks for having me.
You got it. What's the significance of the majority of stablecoins now being issued offshore?
Sure. So I guess if we take a step back, one of the big criticisms of crypto has been its lack of real world use cases. But the evidence is that stablecoins have been that killer use case for crypto. But the problem is for the US, I guess in 2023, we've seen that supply move offshore for basically a couple of reasons. And the first one of those is that the SEC's harsh regulatory environment that they've created by ruling by enforcement, essentially. They essentially killed off BUSD. And now I guess holders are worried that USDC might suffer a similar fate. So if you're an onshore in the US user of stablecoins, you're probably going to move into Tether, who are perceived as having more safety from the SEC's, I guess, jurisdiction. The second of which is that the offshore stablecoins, their supply tends to be a bit less sensitive to US interest rates. So if you're a stablecoin holder based in the US holding the likes of USDC, you're actually earning zero yield. Whereas you have the US Treasuries now obviously earning 4 or 5% yield, and you've easy access to them. If you're an offshore user, however, you don't have that same easy access into US Treasuries. So you tend probably to stick more with Tether or other stablecoins. So we've seen that split basically between onshore and offshore stablecoins, which was 50-50 at the start of this year, go to about 75% offshore stables so far this year.
Let's talk a little bit more about that. How do real rates in US Treasuries affect US-based stablecoins?
Sure. So I guess it's an opportunity cost, really. So as I said, the US-based holders are more sensitive to those interest rates because they essentially have that easy access into US Treasuries. And why would you hold a stablecoin that basically internalizes all the yield? The likes of Circle and Tether earn about $1 billion in profit basically from just internalizing all the yield from their treasuries. And passing none of that on to the users. So if you're a US holder of a stablecoin, it doesn't make much sense when you have easy access to move into treasuries that potentially are even safer and earn a higher yield, whereas those offshore users don't have that same option available to them.
How do Tether's fees compare to Circle's fee structure?
So Tether actually have a mint and redemption fee of, I think it's 0.1 bips. And essentially and Circle have no mint and redemption fee. So what that entails then is that a lot of users essentially redeem their USDC more freely than they would for Tether. So that in turn also makes supply stickier for Tether and more, I guess, more flimsy for USDC.
What role could PayPal and other US incumbents play in the stablecoin market?
Yeah, so in the context of onshore and offshore, I think PayPal can really bring a lot of the supply back onshore for the US. They've obviously put their name behind a stablecoin, and I think a lot of Web2 incumbents will also do the same. Again, this business model of internalizing all the yield and externalizing all the risk of depegs onto users is pretty attractive from a business point of view. So I could see a lot of Web2 incumbents like Visa, like MasterCard, people that specialize in payments similar to PayPal. I could see them putting their name behind stablecoins, and that in turn will help bring stablecoin supply onshore. I think stablecoin, that's probably good for stablecoin adoption. Obviously, you've got PayPal with about 400 million users. We compare that to, I think, the holders of stablecoins. There's about 25 million wallets holding stablecoins. So the scale there for adoption is great for crypto. But yeah, the US really needs to bring some of that supply back onshore.
How is Grayscale's victory impacting the crypto market?
Yeah, well, interestingly, it obviously spiked a couple of weeks ago just after the verdict, and then came back down to about where we were pre-decision. So I think that's more of a longer burn. We could see that play out over the course of a year. The SEC obviously kind of kicked the can down the road by delaying the conversion automatically to a spot ETF. But yeah, as I said, I think that's more of a long burn for markets. What we're going to see there is that's really probably the next catalyst for cryptocurrency markets, with that new wave of capital coming in. Spot Bitcoin ETFs and spot ETFs in general are far more capital efficient than their future counterparts. Futures were underperforming the spot holdings as well. So we're going to see a new wave of kind of financial advisors and institutions deploying capital into those spot ETFs. And again, I think that's just more of a long burn for markets.
And finally, Conor, what are the implications of the SEC's 45 delay on ETFs?
Yeah, well, I think, as I said, that's just essentially them kicking the can down the road. It seems, if you actually look at the wording in the ruling, it seemed to be very dismissive of the SEC's case in general, which was probably what took markets by surprise. The ruling was kind of quite supportive of crypto from the crypto standpoint and Grayscale's standpoint, essentially dismissing the SEC's claims that the spot and future markets aren't correlated. It turns out they are. Futures markets are built off the spot markets. It's the same in TradFi. So I think that's more just of a delaying the inevitable, really, and we will see these spot ETFs come into the crypto market, which again should lead to the next kind of big wave of investment in crypto markets.
All right, Conor, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.